All right, good morning, everyone. After a nice long holiday weekend, we're going to take a look at some of the things that are moving the markets this morning, and it actually started yesterday. This is the first of our portfolio reviews that we'll do weekly that we're going to begin making public to clients and prospects. So kind of exciting, something we normally do every week together. We'll now make this available to our clients and prospects. So the one thing I love to do is, and I'll go ahead and share my screen out now, is to go ahead and just take a look at, some of the trading action for the day. I love having this screen open in advisor watch lists. Whoever's muffling the mic, can you guys mute, please? Thank you. And just taking a look at some of the leadership. So this is really the second day in a row that we've had this quote unquote value rotation. And this is also the second time we've had a value rotation here in the last couple weeks. And I don't want to say that, 2 days in a row or two individual instances over the past couple weeks, sets up a trend for us. But it definitely looks as though, the economy is getting started back up, and we're definitely seeing some of these value plays start coming back into trend. And you can see it here with financials being up 3% today. Some of our historic leadership that the earnings certain proxy is heavily weighted in is suffering just a little bit today. But discretionary is up, staples up. The communication services, this is predominantly your Facebooks, Googles, those are down. Healthcare, which is obviously a huge leadership group, down. And then obviously technology is what's really dragged the market down today, which is why the Dow is up so high. Keep in mind the reason why the S&P is struggling to break even today is because of the heavy weight of those top 5 holdings, and they're predominantly being the tech names and your Google and Facebook names up here in the communication services. So again, just having all of the SPDR ETFs open in your quote monitor and advisor tools under your ETF watch list, just a great way to start your morning. And so let's dive into a little bit about some of this value rebound that we're seeing, just to see, visually what it looks like. And to do that, we're going to bump into the Zacks Research System. And this is one of the 4 portfolios that I maintain that is actually one of the portfolios that the earnings certain portfolio is distilled from. And the reason I love looking at this portfolio in particular, it's the cyclical proxy, the ticker symbol ZCYCE for equal weight. And it really gives us a really good idea of how all of these value stocks, these stocks that are economically sensitive to any business cycle, are behaving. And we can look right now in default, I've got the valuation model up. We can look at earnings that are lagged 1 year. We like to lag earnings. It just gives a nice visual fit to a forward PE ratio when you look at the difference between the blue price line and the orange forecast earnings line. If I take the lag off, then you're looking at a trailing 4 quarters. You can see actuals here in the bold orange, and then your estimates in the dotted, and you can see how the price lines up pretty much to the most recent quarter. So I like to look at this stuff lagged, and I also like to look at it from the perspective of, how far out the buy side is really going and looking at this recovery when they're doing their valuation work. And remember that during, uncertain economic times, the market implied growth rate that the buy side will assign to the cyclical basket of stocks is roughly GDP growth. And if we keep the fulcrum point on forward 12-month earnings, which is this point right here, and we do a market implied growth, which will set the current model return equal to 0 here, what you'll see is that we get something that's really, really high, right? It's 6 3/4%. And so we know that that growth rate is much too high, which basically tells us that the buy side is looking much further out in the earnings stream. And I always like to go forward 24 months or even further when I see this type of action at the bottom of a trough here, which is what we're looking at. So what I'll do is I'll just bring my fulcrum line of those normalized earnings trends up. So we're basically modeling any earnings point across this line. So the idea is if we take it out to forward 24 month, which is where this green diamond is, and we do a market implied growth rate there, we're now getting more towards a realistic market implied growth rate for the cyclical basket of stocks. Remember, long-term cyclicals will traditionally grow at the rate of GDP growth, maybe just a touch higher. And it makes sense because these are the stocks that are economically sensitive to the business cycle. So we know we're looking at market implied growth rates or valuations. Buy side is basically bid value 2, that is at least 24 months ahead, maybe even more, right? We can see we get into more normalization here. So again, we can bring that fulcrum line up. We can model points towards the end of 2021, and we can see that we get even closer to GDP growth. So this is more realistic. We can see the size of this rebound. Over the last week, I've had a lot of questions about like JP Morgan, is this a good time to take a look at that? And, my response is, absolutely. Just know where the financials are overall. What we're going to do to take a look at the financials is we'll use composites for the S&P 500, the S&P 500 market-weighted financials composite. And this is going to be a really, really good valuation proxy for the market-weighted average financial stock. And what I want you all to see is that the financial sector itself is trading exactly the same way as that basket of cyclicals is trading, okay? And so this is going to be, again, very indicative of the fact that investors are not focused now on the trough, but yet this rebound we're experiencing, this little uptick in blue, is based on the fact that we are seeing some green shoots in the economy. We are seeing states reopen. And commensurate with that, we're now looking out to earnings that are going to be more normalized, okay? And the reason I say earnings that are going to be more normalized is if we take a look at the current Treasury yield curve, and this I did take a quick peek at. I look at this every couple days. And what I'm looking at is current point relative to a week ago, relative to a month ago. And I'm not seeing a whole lot of change in terms of deepening. And you can see that we're still really working through the recession. You can see that every time we work through a recession, these rates just collapse along with, the spreads are the first thing to collapse, then the rates collapse. So we're still working through that. Any real change here, which is really, really key to understanding the behavior of the financials, which is why this curve is really looking and focusing more towards earnings that are now not necessarily 12 months out, right? Because the yield curve is flat, spreads are pretty flat. Narrow, we've got a really hard time making, net interest income for banks. So we're going to do the same exact thing that we did for the cyclical basket, which is primarily comprised of industrial stocks, proxy. And we're just going to bring this green dot up to the orange earnings line, and we're going to solve for the current model return that sets this model into equilibrium, which puts the current model return in. I'm just going to click on the market implied growth rate at the proper earnings level. We'll see that, in fact, the market is not expecting really any growth from the financials. And this is something that I've been saying for months. I've actually been saying that for a lot longer than months. But specifically going into this downturn when, as of Q4 of last year when we really saw those spreads collapse. So if someone asks you about, JP Morgan, really can't talk about JP Morgan without having an understanding of how the entire financial sector is being valued right now. So it's basically being valued at no growth. It's 0.91. And so if we put JP Morgan up on the screen, what you're going to see probably is something very, very similar to the market-weighted financial sector. And the reason you're going to see this is because financials is one of those tilt sectors, right? You own one, you own the whole basket. And so if I set this model back to default, you'll see that JP Morgan has very similar price action as the overall financials sector. It's got a little bit of an uptick here, so a little green shoots, got a really deep trough. And again, we've got the buy side looking well beyond 12 months for recovery. We're looking at normalized earnings somewhere out here between 24 months and even 36 months out. So if we were to click on a market implied growth rate with the fulcrum at F12, you could see that we're actually at a market implied growth rate of 3.81. But if we do the same thing that we did with the financial sector, which is to bring the normalized earnings trend line that we're modeling up to the actual sell side forecast estimate for F24, now you're going to end up with a scenario that's 0.23, right? So JP Morgan is actually a little bit cheaper than the market-weighted average financial stock. So you could say that, you know what, if you had to own a financial, JP Morgan would probably be best of breed, and it's actually trading at a little bit lower market implied growth rate than the overall financial sector. So this one would be attractive, again, if you had to own a financial. Again, Treasury yield curve environment is super tough for these guys to make money, and that is exactly why I have a market implied growth rate of basically zero. So again, I could show you a lot of other stocks that have a much higher market implied growth rate, which is why I'm obviously not necessarily a fan of the financial sector or even JP Morgan at this point. One of the things that I want to look at too, guys, is to talk about, you know, what's happened with some of the technology leadership over the last couple days. If you look at where technology stocks have been since at our tilt call, I mean, they have just been on an absolute tear ever since we made the recommendation. It was the very first tilt recommendation. Basically overweight the top 5 names in the S&P 500 sector, or I should say the S&P 500. Those 5 stocks, including Adobe, have just absolutely been on a tear. So a little bit of a mean reversion trade is, again, I don't know if this value rotation is really got legs. What you're going to find is that every single time we come out with, you know, a new vaccine promise, you know, you're going to get this value rotation. The idea is, you know, is it real? How long is it going to last? And when I say is it real, you know, is the vaccine real? Are these clinical trials? Is it, you know, is everything up to snuff, and is it really good result? We saw the Moderna trial break down. We've got some other results coming in now that have kind of triggered this value trade. The idea is when you apply the tilts, you know, you've got to look at where the growth from in the S&P 500. And we've already identified that from a price perspective. We've looked at it from an EPS revision perspective. But now that it's March 27th, you've got actuals that have come in for the March quarter. And keep in mind that this is lag. So if I take the lag off, you can actually see that Q1 actuals are in for our bottom-up reconstructed composite proxy. Okay? So you can actually come in here, look at under financials, one of the most powerful views in the entire Zacks research system, growth and margin. We can come and dissect the year-over-year percentage change in earnings growth, EPS growth, revenues per share growth, and revenue growth. And on here is this EPS column. I'm looking at the March 20 row. See that the S&P 500 earnings have actually declined 11% year over year. This is actual. This is a huge number. And one of the reasons why perhaps the IT sector, something that we expected to see off of the revisions that we were looking at going into Q1, that technology had held up so well. That's actual. They actually came in. The IT, the market-weighted average IT, actually up 8%, guys. 8%. Okay. Keep in mind, the S&P 500 down 11%. It's That's a 19% differential. So my question to you guys on the call is, if IT sector that represents 25% roughly weight of the S&P 500 was up 8, that's 25% of the weight of the S&P 500. That's huge, right? And the overall SP5M negative 11%, that means that the rest of the sectors were just a complete wipeout, right? For the most part. We don't even have to go in and do the sector analysis, although we could very easily. This is really what's driving the market. So you've got investors that need exposure to the S&P 500. The reason why the S&P 500 is struggling today relative to the Dow is because the mega tech stocks, the big cap tech names, are down. So the question is this a real cyclical rotation, or is this just, a mean reversion temporary type trade? And I'm more in the camp at this point of it being a mean reversion temporary trade, only because the thing that works against the theory of this being a long-term secular trend in value overgrowth is that those that are still seeking exposure and closet marking to the broader index, the S&P, still got to have exposure to those top 5 tech names. So that's going to work against itself in trying to have this value over growth rotation. It's going to be very, very difficult unless we get some real strong economic activity. The tech sector is still your safe haven because it is the only sector that is growing at this. Okay, it's just astronomical. And I shouldn't say the only sector. I haven't there. We certainly could. That's obviously strong, but we know that there's been secular issues even inside healthcare. Even healthcare solid, right? Another leadership group, 11%. But the rest of these are going to be just a complete. So, at any rate, those are some of the thoughts that I wanted to leave you with today. Does anybody have any specific questions?
Tim, Tim?
Yep.
Tim, can you hear me?
Go ahead. Yes.
Yeah. Of course, you always talk so much about tilt sectors or tilt bets to make. And of course, more recently, you've of course been very anti even utilizing or actually getting into the banks. What would actually trigger your decision making to start to get into banks?
I would have to see the early signs of a recovery in the actual yield curve, and I'd want to see spreads actually start to widen even more than they have already. And that's one of the reasons why I monitor this treasury yield curve, Adam, that we have in CRS. And I would say, couple that with some real progress on either some sort of, viral therapy or, some real measured success in advanced clinical trials for a vaccine. Those two things in and of itself will definitely help Treasury yield curve, and this is really kind of the lifeblood of self-exposed back into the financial sector. Right now, JP Morgan is a great stock. It's actually trading at a little bit of a discount from a market implied growth perspective to the market. Like I said, if you've got to own that, that's a great name to own in this environment. But you've got to have a long time horizon. It's cheap right now for a reason. Once we get through this rough patch, with these rates just collapsing and spreads collapsing, and we can start making our way through this recessionary trough, financials will be attractive again. Adam.
Thank you.
All right. Anyone else? All right. I'm going to go ahead and turn the recording off.